Filing taxes with RSUs can feel like a scavenger hunt. You got W-2s buried in 3 different portals, 1099-Bs that somehow show zero cost basis, and supplemental statements that you didn't even know existed. You miss one of these documents, or you transpose one number, and you're facing an IRS mistake letter asking why you did report income on something you've already paid taxes on. Hi, I'm Jonathan Nagy, founder of Alpine Road Financial. I've navigated a few IPOs myself, and I've worked at Apple and Square, and now I help countless tech professionals decode the chaos that comes with equity comp tax season. Today, I'm giving you the complete step-by-step checklist of every form you need, where to find it, and exactly how to use it on your return so you can file with confidence to keep more of what you earn in your pocket. So first, let's start with the form you think you know, your W-2. When RSUs vest, the fair market value on that vest date gets added to your ordinary income. That's the number you've already paid taxes on through withholding. But here's the catch. Your W-2 doesn't separate your salary from your RSU income in Box 1. Box 1 shows your total wages, salary, bonuses, and RSU vesting all combined, while Box 3 reports Social Security wages, which includes RSU income up to the annual wage base. Box 5 reports Medicare wages with no cap, so all your RSU income shows up there too. And if you're lucky, your employer used Box 14 to separate disclosed RSU income with the letters RSU and the dollar amount. But that's optional, not required. Why does this matter? Because when you sell those shares later, your 1099-B is going to show the sale proceeds. If you're not careful, you could end up paying tax twice. Once when the shares vested and showed up on your W-2, and again when you sold them. We'll come back to that in a minute. Do not forget state sections on your W-2. If you worked remotely across multiple states, your RSU income needs to be allocated based on where you actually worked, not where your company's headquartered. That means you might owe taxes to 2 or even 3 states on the same RSU grant. Keep a log of your work locations if you moved or work remotely during the vesting period. Now let's talk about the 1099-B, the form your brokerage sends you when you sell RSU shares. This is where things can get a little messy, so pay attention. Your 1099-B reports the sale proceeds, which is what you received when you sold your stock. It also reports the cost basis in Box 1E, which should be the fair market value on that date the shares vested. But here's the problem. Many brokerages report as zero, or they leave the cost basis blank for RSUs because they weren't purchased. They were compensation. If you don't adjust that cost basis on Form 8949, the IRS assumes you bought the shares for $0 and will tax the entire sale proceeds as capital gain. That's what we call double taxation. You don't want that. You've already paid ordinary income tax on the vesting value. So let's walk through a hypothetical scenario. Imagine you have 200 RSUs vest when the company's stock is trading at $40 per share. That's $8,000 of income reported on your W-2. You pay ordinary income tax on that day the shares vest. 6 months later, you sell those shares at $42. Your actual gain is only $400, which is 42 less 40 times 200. The difference between the vesting price and the sale price. But if your 1099-B shows a zero cost basis, the IRS thinks you made $8,400 in capital gains. You'd be taxed twice on the same $8,000. To fix this, you use Form 8949 and you enter the correct cost basis, which is the vesting day fair market value. Use the adjustment code B if the broker reported an incorrect amount. Now cross-reference your W-2 and your employer's supplemental RSU statement to get the exact vesting day price. One more trap is wash sales. If you sell RSUs at a loss and then repurchase that same stock, maybe through an ESPP or another RSU vesting, within 30 days, the IRS disallows that loss and adds it back to the basis of your new shares. Most brokerages auto-adjust this on covered securities, but you'll need to track it manually if you're buying and selling across multiple accounts. Now, Chapter 3, your employers should provide a year-end supplemental statement or an equity compensation summary. This is not an IRS form, it's an internal report, but it's critical for reconciling everything else. This document breaks down every RSU tranche that vested during the year, the grant date, the vesting date, and the number of shares. And finally, the fair market value on vesting date and how many shares were withheld for taxes. It's your special decoder ring. Without it, you're guessing at cost basis. Log into your stock plan portal, E-Trade, Fidelity, Schwab, Morgan Stanley, whatever company they use, whatever company your company uses, and download this report before you start filing. If your employer didn't auto-generate one, you can usually export a custom report showing all the vesting events for the tax year. Save it as a PDF and keep it with your tax records for at least 3 years. Now, if you had multiple grants vesting throughout the year, this statement is the only way to track which shares correspond to which vesting event. That's especially important if you sold some shares, but not others, or if you're trying to minimize gains by selling specific lots against different grants. So now, if you've been at the company for a few years, you likely have had multiple RSU grants vesting on different schedules. Each grant has its own cost basis, and each vesting event creates a new tax lot. Create a personal tracking spreadsheet. Include columns for grant date, grant ID, vesting tranche number, vesting date, and number of shares vested, and what the fair market value was on those vesting date, and finally taxes withheld, so you know the net shares you received after that tax withholding. Update it every quarter when shares vest. This isn't just for this year's tax return, it's for planning future sales. If you want to minimize capital gains, you can choose to sell specific lots or the ones you've held long enough to qualify for long-term capital gains treatment. But you cannot do that unless you know which shares are which. Now, if you're at a pre-IPO company and shares haven't been liquid yet, this tracking becomes even more important. Once liquidity hits, you'll have years of vesting history to reconcile, and your broker won't have full records. So hear me now, start the habit of tracking now. So now let's talk about how to stay organized. Here's my system, and I recommend this to every client. Create a dedicated folder on your computer labeled by tax year. 2026 taxes, for example. Inside that folder, create subfolders for W-2s, 1099s, RSU statements, and receipts. Scan or download everything. Your W-2, every 1099-B, your equity comp summary, grant history exports, and any email from your employer or broker about tax withholding. Save them as PDFs with clear file names. For example, 2026 underscore 1099-B underscore Fidelity underscore RSU underscore sales. Use a secure cloud backup, Google Drive, Dropbox, or iCloud. I don't care, but just make sure you're not scrambling if your laptop dies in March. And if you're working with a CPA, this makes file sharing seamless. For physical backups, print one copy of your final return and supporting schedules and file it in a binder by year. The IRS can audit you up for 3 years after filing or longer if they suspect underreporting. So long story short, keep everything. Okay, now let's put it all together. Here's how to enter your RSU data into tax software. You may be using TurboTax, H&R Block, Free Tax USA, whatever you use without double counting income. Step 1, enter your W-2 exactly as it appears. The software will auto-populate your wages from box 1, which already includes your RSU vesting income. Do not manually add RSU income again. Step 2, go to the investment income section and import or manually enter your 1099-B. The software, it'll ask you for proceeds and cost basis. If your broker reported 0 or has an incomplete cost basis, you'll need to override it. Enter the fair market value on the vesting date, which you'll get from your supplemental statement. Now, step 3, the software now generates Form 8949 and Schedule D. Review the capital gains summary. You should only see gains or losses based on the difference between your sale price and your vesting day fair market value, not the full sale proceeds. So step 4, check your income summary page. Your W-2 wages appear once. Your capital gains appear separately. If you see RSU income listed twice, go back and remove any duplicate entries. Step 5, repeat this process for your state return. If you lived or worked in multiple states, you'll need to allocate RSU income based on the time you spent working in each state during that vesting period. This can get complicated very fast. More on that in the next chapter. All right, you can absolutely file your own return if your situation is straightforward. But there are red flags that mean you should get a second set of eyes or hire a CPA who specializes in equity compensation. First, if your total income, including RSU vesting, pushes you over $1 million, you are now in the top federal bracket and likely facing supplemental withholdings that do not match your actual liability. You'll owe quarterly estimates or face penalties. Second, if your withholding on your RSUs was only 22%, but your actual marginal rate is 35 or 37%, you're gonna have a big surprise at filing. Run the numbers now, not in April. And third, again, is that multi-state issue. If you move mid-year or work remotely, RSU income is sourced to the state where you perform that work, not where you live or where your company is based. Now, California is especially aggressive on this. A tax pro can help you navigate non-resident returns and avoid double taxation. Fourth is large discrepancies between your records and your 1099-B. If your broker is missing cost basis data for multiple tranches, or if you can't reconcile which shares were sold, do not guess. Get help. Fifth, if RSUs represent more than 10% of your net worth, or if you're sitting on highly concentrated stock positions, it's time to talk to a financial planner like me who understands equity comp strategy, not just tax prep. Look, you've simply worked too hard to leave your equity compensation to chance or to overpay the IRS because of a missing form or some silly transpose number. If you want more trail days and less stress, let's talk. Your equity should fund freedom, not confusion, and I'll show you how. Meanwhile, visit alpineroadfinancial.com to check below to see my free equity tax checklist or schedule a consultation to map out a strategy that fits your life, not just your tax bracket. Let's design a plan that buys back your time for what really matters.